Mahesh Nandurkar, India strategist at CLSA, joins us right now on the show. Mahesh, so good having you. Thanks for speaking to us at Bloomberg Quint. This is Neeraj here. Good morning. I fear a half an hour window might also not be enough considering the issues that we have at hand, Mahesh. But let's try and piece all of this together in the next 10-15 minutes. Starting off with the macro worries, Mahesh. What's your individual gut opinion or the House opinion on the impact that could have on flows and markets as a result of what's happening to the yields, one, and to the currency, two?
Well, yes, as you rightly mentioned, the macro is clearly become much more adverse over the last 6 months or so. And, clearly there is, no sign of relenting. We are seeing oil going up. We are seeing the local bond yields going up. Now, even the US bond yields have, also breached that, technical 3% mark. So on the whole, I would say that the macro is not really looking great. And that's what makes us cautious, on the markets, because the valuations are also at a higher level. Nifty trades at about 18.5 times or so from the, on the 1 year forward earnings basis. So we don't really have too much of cushion at this point in time. The big sort of saving sort of factor for Indian markets has been very, very strong domestic flows. They still continue even in the month of March. If you were to adjust for the factor of the arbitrage funds, the flow into the pure equity funds was also very strong. We'll see what happens into like April and May. But that is one single factor, according to me, which is helping the Indian markets, as of now. And any sign of weakness over there can have a negative impact on the market outlook.
Mahesh, so what gives? I mean, from those 9,800, 9,900 levels, there is a bit of a pullback that we've seen. Arguably, the expectations of a fairly decent quarter of earnings now and FY19. The management commentary thus far, I must say, has been fairly impressive too. What happens? Do you sense, because of the valuations and the macro, a higher probability of a drawdown before we stabilize or move higher?
Yeah, I would say that, from a 12-month perspective, or even, from the rest of the 2018 calendar year perspective, I think, we should probably be expecting only a single-digit return from the market. So keeping that in mind and keeping where the bond yields are, many of the sort of AAA corporate bond, are offering 8.5%, 9%, even more than that, kind of yield. So at this point in time, I would say that the risk reward seems to be unfavorable for the equity markets. I would be, happier investing, in the debt market as of now.
Mahesh, with voices growing louder with respect to a change in the interest rate trajectory in India, what's your view here and what impact can it have on Indian equity markets?
Well, the trajectory has already changed in the sense that the bond yields, which bottomed at about, I'm talking about the 10-year government bond yields, which bottomed at about, let's say, 6.4, 6.5, the middle of last year. Now we're at about 7.7, 7.8 kind of a zone. I would say that, a large part of the potential fiscal slippage or, even the fact that the inflation could be moving upwards to a large extent have factored in. Maybe another 20-30 bips from here on, on the bond yields as such. But yes, I think there could be some more adjustment that the banks might be doing. We've already seen some of the large banks taking up the lending rate by about 15 to 20 bips. Maybe another similar increase could be likely going forward. So clearly this is not a great outlook for the Indian equity markets. So as I sort of mentioned before, we are looking at a single-digit return from the equity market from here on, especially because we have seen a pretty nice pullback to about 10,500, 10,600 on the Nifty, as we can see over the last 1.5 months. And mind you, this has happened despite the fact that the oil has just kept on going up over the same period. And if you look at the historical analysis and the correlation between the oil price movement and the relative performance of the Indian market, it is probably inversely correlated in the event where the oil price increase is driven more by supply side. See, if the oil price goes up because of the very strong global demand, then it's a different matter, because then it means that the situation is improving all over the world, the economic outlook is great, the risk appetite is more, and then in that kind of an environment you see more inflows into the emerging markets and also in India. But currently, I would say that the oil price hike is driven more by the supply related factors. So that kind of an environment is not really a great environment for the Indian markets to do much better.
Okay, Mahesh, so in light of all of this, and actually maybe if I can just throw in one more macro question before we get to the micro, I really want to talk to you about the Mumbai DP plan. You guys have been one of the foremost guys and consistent guys in talking about real estate. But just one quick question, this whole chat about Trump and Iran and the deal and maybe a pullout from there as well, how big an overhang would be a global factor? Because hitherto, the last 6 months, we've seen global markets and the Indian markets in turn overcome almost all hiccups, be it the trade war talk, be it the Syrian strikes, and now maybe this overhang of the US-Iran deal talk failure.
Well, yes, on the global front, there are a few risk factors. One that you're clearly mentioning, which can have further adverse impact on the oil prices, as in the oil prices could move up, if that were to happen. Apart from that, over the next 1 or 2 months, what we will be sort of keenly watching out for is the stance taken by the ECB. Remember that there is some expectation that ECB's commentary could turn a little bit hawkish, and there may be some moderation in their bond sort of purchase program. The US bond yields have already crossed 3%, which means that and which has also resulted in a bit of a strengthening of the US dollar currency as well. So these are further risk factors for the equity markets in general, and specifically for India.
All right, Mahesh, in one of your notes, you've also mentioned, spoken a little more about the political scenario in India itself. How critical is the Karnataka state election? Well, I do know that you mentioned it's only about sentiment, nothing more. But what can it mean when it comes to the 2019 general elections, and what sort of an influence can that have on equity markets?
Well, my chats with variety of fund managers internationally and also domestically, the message is very clear that the stock market participants ideally want the same government to return in 2019 elections, right? So any incremental data point which will support that thesis will be liked by the market, and in that context, the outcome of the Karnataka state election is going to be a very, very important data point, because the next possible data point will be coming only maybe another 6-8 months down the line, when we have the elections in the state of Chhattisgarh and Rajasthan and MP. So in the remaining of the 2018, the Karnataka election is a very, very important data point. And if you see the the events over the last 2-3 months, I would say that the market has gotten a little bit concerned about the possible outcome in 2019. So it'll be really interesting to see what happens in what happens in the Karnataka state election. If the BJP is able to form the government over there, then that is something that will clearly be liked by the market.
Okay, so Mahesh, which brings us to what should or what is it that you would advise your key clients to do in terms of themes as well? One, the standard question of what do you think works well in the scenario of a 12-month return of a 12-month single-digit return that you are making a case for?
So I would say that some of the themes that look very interesting is one is housing recovery. So as you rightly mentioned, we have been talking about this theme for quite some time. We continue to be very, very optimistic on that. the anecdotal evidence and data that we're collecting seems to be supportive of that thesis. If you also see the numbers being reported by the property developers over the last 6 months, and also the recent commentary continues to make us optimistic. So I would say that the best way to play the potential housing market recovery would be the real estate developers themselves, followed by the housing finance companies, and then some of the select building material companies as well, such as cement, to a smaller extent, but I would say the bigger beneficiaries could be the consumer durable companies, which supply household products like the fans and the lighting equipment, etc. Also the plumbing pipes and the other construction sort of related companies. Also the EPC contractors, which also have clearly some sort of play on the housing recovery as well. So this remains our single most high conviction theme ideas over the next 12 months. In fact, I would say that the housing market recovery will be a multi-year theme in my view. It's not just a 12-month theme. It's a theme that should ideally unfold over the next 4 to 5 years.
And at the risk of overgeneralizing, Mahesh, how would you peg staples versus consumer discretionaries right now?
Well, yeah, so that's an interesting question. So, yeah, so our sort of single biggest high conviction theme is housing. Then second would be rural, because clearly with the next 12 months in mind, the government's focus is going to be definitely on reviving the rural sentiments. We are already seeing some initiatives on that side, and we are expecting a pretty steep increase in the MSP for the upcoming summer crop season, the Kharif crop season, which should further boost the rural demand recovery. And from that perspective, consumer staples, some of the select consumer staple names look pretty interesting. I would basically go with the consumer names that have a higher proportion of demand coming from the rural side. That's one. Among the discretionary side, we would go with the autos, especially some of the premium and auto segment, which could also see some demand improvement coming through as well. So, but clearly rural will remain in focus, which would include staples, tractor companies, and some of the two-wheeler companies.
Anything niche consumption, Mahesh? And again, I'm just kind of making a bit of a narrow focus out here. But one is what staples are doing. Two is the different forms of consumer themes which are coming both in the private markets and in the listed domain as well. Are you guys liking anything? Because the valuations are exorbitant, but maybe the growth numbers are here to stay.
I think one sub-segment of the consumption theme, which is doing pretty well, where the growth seems to be improving, is the QSR, the quick service restaurant model, or the food services segment. I think that is one segment that is looking quite interesting to us. Okay.
Well, the key highlight from me from this interaction, Mahesh Nandurkar, thank you so much for joining in today and giving us your thoughts. Really appreciate your time. And look forward to having you more often on this forum.
Thank you very much, Neeraj.